What if I told you the difference between paying $60,000 and $15,000 on the exact same loan usually isn't income? It's information, and most people never get it. Student loans are designed to be confusing, and that confusion quietly costs you money, sleep, and years of stress you never had to carry. But here's the good news. It's a system with rules. And once you know the rules, you can make them work for you instead of against you. I'll show you how to pick the right repayment plan, slash what you actually owe, and tap into forgiveness programs most people don't even know exist. Less money out of your pocket, a lot less stress in your life. Let's get into it. First, let's understand what you're actually dealing with. There are two fundamentally different kinds of student loans. Confusing them is the most expensive mistake people make. Federal loans come from the government. Private loans come from banks, credit unions, and online lenders. On paper, they look the same. You borrow money, you pay it back with interest. But they are not the same animal. Here's why that matters. Federal loans come with protections that private loans simply do not offer. Income-driven repayment that caps your bill based on what you earn. Forgiveness programs that can wipe out your balance. Private loans, you're at the mercy of the lender's terms. Whatever the fine print says, that's it. No guaranteed safety net, no forgiveness, no flexibility. So burn this into your memory. Rule number 1, if you have a choice, max out your federal loans before you ever touch a private one. It's the single easiest way to protect yourself. Within federal loans, you've got a few types, and the differences matter more than you'd think. First, direct subsidized loans. These are the best deal available. Why? Because the government pays the interest while you're still in school. Your balance sits still and waits for you. Next, direct unsubsidized loans. These accrue interest the entire time, even while you're studying, even before your first payment. That balance is quietly growing in the background. And then there are plus loans, built for grad students and parents, which carry the highest interest rates of the bunch. Now here's the thing nobody tells you at 18. The interest is the real enemy, not the principal. Borrow $30,000, pay only the minimum, and you can easily hand back $50,000 or $60,000 over the life of that loan. Here's how they get you. Interest capitalizes. Your unpaid interest gets added to your principal, and then you start paying interest on your interest. That's the trap. That's how people end up owing more than they originally borrowed, years into repayment. So the big picture mindset is simple. Minimize what you borrow. Know your interest rate, and never just passively pay the minimum without a strategy. Which brings us to the part that changes everything, repayment. When your loans finally come due, usually about 6 months after you leave school, you get dropped onto a default plan automatically. You don't choose it. It just happens. Here's the catch. You don't pick your plan. The moment your loans come due, the system drops you onto a default, automatically, whether it fits you or not. For most people, that default is the standard 10-year plan. Fixed payments, 10 years, done. And here's something worth knowing. If you can afford it, the standard plan actually saves you the most money in total interest because you pay the loan off the fastest. But if you can afford it is doing a lot of work in that sentence. A lot of people simply can't swing those payments. And that's exactly where the other plans come in. The big category to understand is income-driven repayment, or IDR. Here's the magic of it. These plans cap your monthly payment at a percentage of your discretionary income, not your total balance. So if you don't earn much, your payment stays low. In some cases, it can even drop to $0 a month. And here's the part to burn into your memory. That $0 payment still counts as a qualifying payment toward forgiveness. Read that again. Paying nothing, and still moving closer to having your loans wiped out. Remember that one, because it becomes very, very important later. Now, the specific IDR plans have been a moving target. Some, like income-based repayment, have existed for years, while newer plans have hit legal challenges and constant changes. Because the rules and even the names shift with each administration and the courts, you need to verify the current options yourself, not trust any video, including this one. Go straight to studentaid.gov, the official federal site, and check what's actually available right now before you enroll in anything. But the core principle never changes. Income-driven plans lower your monthly payment by stretching the term out to 20 or 25 years. And at the end, any remaining balance is forgiven. The trade-off? You pay more interest over time because you're paying slower. So here's the strategic question that changes everything. Am I going to pay this loan off in full, or am I aiming for forgiveness? Those are two completely different games. Paying in full? Go shortest term, most aggressive payments, and attack your highest interest loans first. Aiming for forgiveness? Do the exact opposite, the lowest legal payment possible. Because every dollar you don't pay is a dollar that gets forgiven later. One more thing on repayment: refinancing. Private lenders will offer to refinance your loans at a lower interest rate. Tempting. But here's the trap. If you refinance federal loans with a private lender, you permanently give up all your federal protections and forgiveness eligibility. Once it's done, you can't undo it. Ever. So only refinance federal loans if you're absolutely certain you'll never need income-driven repayment or forgiveness. And the rate savings are genuinely significant. Private loans, though? Refinancing there is much lower risk because you're not giving up anything special in the first place. Okay, this is the part you came for. Loan forgiveness is real, it's legal, and most people leave money on the table simply because they don't understand the rules. The big one is Public Service Loan Forgiveness, PSLF. If you work full-time for a government employer or a qualifying nonprofit and you make 120 qualifying monthly payments, that's 10 years' worth, your entire remaining federal balance is forgiven. Tax-free, and there's no limit on the amount. Now here's where strategy comes in. Because that forgiven amount is unlimited and tax-free, you want those 120 payments to be as low as legally possible. So the smart PSLF play is to enroll in an income-driven plan with the lowest monthly payment, not the standard plan. Every dollar you keep in your pocket during those 10 years is a dollar that gets wiped out at the end. The catch is paperwork. Your loans must be direct loans, you have to be on a qualifying plan, and you have to certify your employment. So the trick isn't a loophole, it's discipline. Submit the employment certification form every single year and confirm your payment count. Here's one a lot of people miss. If you have older federal loans that aren't direct loans, like FFEL loans, they don't qualify for PSLF on their own. But you may be able to consolidate them into a direct consolidation loan to make them PSLF eligible. That's a genuine strategy worth looking into. But be careful. Consolidating can reset certain payment counts, so check the current rules first before you pull that trigger. Now, what if you don't work in public service? You're still not left out. IDR plans forgive your remaining balance after 20 to 25 years of payments. But here's the catch. Historically, that forgiven amount could be treated as taxable income. People call it the tax bomb. The tax treatment has changed over time and depends on current law, so verify it. Don't assume. The principle stands. If you're on track for IDR forgiveness, plan ahead for a possible tax bill in the forgiveness year. Don't let it blindside you. And here's something almost nobody talks about. Teachers in low-income schools, nurses, doctors, public interest lawyers, and people in the military all have access to specialized forgiveness or repayment assistance programs built just for them. So if you're in any of these fields, search specifically for programs tied to your profession and your state, because state-level programs are some of the most overlooked free money out there. Most people never even look, and they leave thousands on the table. Don't be one of them. Go look. Here's a legitimate trick a lot of people miss. Periodic government adjustments and account reviews have, at times, retroactively credited borrowers with qualifying payments they didn't even know they had. So regularly check your official payment count at studentaid.gov. You may be closer to forgiveness than your servicer's records first show. People have had years of credit restored just by requesting a review. Now, the most important warning, companies will call, text, and email promising to forgive your loans for an upfront fee. Scams. The government never charges. If someone wants a fee, hang up. Everything legitimate is free at studentaid.gov. So let's tie a bow on this. 5 steps. 1. Know your loans. Log into studentaid.gov and see exactly what you have. You can't strategize blind. 2. Decide your game, paying in full or aiming for forgiveness. And if you work in public service, PSLF should be on your radar immediately. 3. Pick the plan that matches that game. Lowest payment if you're chasing forgiveness. Fastest payoff if you're not. 4. Protect your federal benefits. Don't refinance away your forgiveness eligibility unless you're certain, and never pay anyone a fee. 5. Verify everything on the official site, because the rules genuinely change, and the people who stay informed are the ones who save the most. Student debt feels overwhelming, but it's a system with rules. And once you understand the rules, you make them work for you, not against you. The difference between paying $60,000 and $15,000 on the same loan usually isn't income. It's information, and now you've got it. Here at Finance Physio, that's the whole mission, taking the stress out of your money and getting you financially healthy. So subscribe, hit like, and drop your questions below. Now go check your loan balance, seriously, right now.